Hey there, I'm estate planning attorney Paul Rabelais, and in this video, we're going to talk about how moving to a no income tax state could cost your heirs big time. So, if you're thinking about moving to a state with no state income tax to save money in retirement, I get it. Places like Florida and Wyoming are really appealing. But what if I told you that moving could cost your family hundreds of thousands of dollars or maybe more in extra taxes after you're gone? So most people don't realize this, but if you're moving from a community property state to a separate property state, you could be giving up one of the most valuable tax benefits available to married couples. And it has to do with something called the step up in basis rule. Let me explain. So, yeah, I'm Paul Rabelais. I'm an estate planning attorney. I'm based in Louisiana. I serve families nationwide. We built a network of attorneys across the country so you can get the same expert level and well rounded estate planning, regardless of your location, with me personally guiding the creation of your plan. All right, so if you live in one of these 9 states, Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin, you live in what's called a community property state. That means generally that things you and your spouse earn or acquire during your marriage are owned 50-50 by both of you, really regardless of whose name the property's in. So, for example, if Fred and Wilma were married and they lived in a community property state and Fred bought some stock, I'll give you that example here in a moment, and all of that stock is in Fred's name. Well, that stock is community property because it was acquired with community property with funds that were acquired during the marriage. So that stock or property acquired that's in Fred's name, if Fred and Wilma lived in a community property state, then that stock or that asset will be considered community property owned 50-50 by each of them. And since we're talking about estate planning, I'll at least mention sometimes people confuse these rules that when a married person inherits, the inheritance is the separate property of the spouse who inherits, at least perhaps until they commingle that inheritance with other community property that they have with a spouse. So, for example, if Fred, while he was married to Wilma, if he inherited some stock, say from his parents, then that stock that Fred inherited is Fred's separate property, even if Fred and Wilma lived in a community property state. But that really, the inheritance is a separate property issue, is not the main focus of this video. So let me give you another example. Let's say Fred and Wilma bought stock 25 years ago and they bought it for $300,000 and now it's worth $3 million. Bought it for $300,000 25 years ago. Now it's worth $3 million. That means there is $2.7 million of unrealized capital gains. Now, here's where the magic of living in a community property state comes in. When one spouse dies in a community property state, living in a community property state, domiciled in a community property state, well, both halves of the community property, or in our Fred and Wilma case, all of that $3 million of stock, gets a full step up in basis to the current fair market value when the first spouse dies. That means the surviving spouse can sell that $3 million of stock with zero capital gains tax. Again, Fred and Wilma bought stock 25 years ago for $300,000. Today, it's worth $3 million, $2.7 million of unrealized capital gain. Fred dies at a time when Fred and Wilma lived in a community property state. And because they lived in a community property state, all of the community property, not just Fred's half, a lot of people make that mistake. They believe that only the deceased spouse's half of the community property gets a step up in basis. But no, the rule is it's a real benefit to people who live in community property states. All of the community property gets a step up in basis, not just the deceased spouse's half, but also the surviving spouse's half. So, on the other hand, if they lived in a separate property state, like Florida, like North Carolina, like South Carolina, like Georgia, there's about 40 separate property states. Only the half that the deceased spouse owned gets a step up in basis. So under those circumstances, if the surviving spouse sells that stock, they will owe capital gains tax on $1.35 million or more of gain. So here's how that works. If Fred and Wilma didn't live in a community property state, let's say they lived in Florida when Fred dies. Well, and let's say that stock was jointly owned. Well, only Fred's half of the stock gets a step up in basis. Wilma, the stock was worth $3 million when Fred dies. Fred owned 1.5, Wilma owned 1.5 million. Wilma's half of that stock, which is worth 1.5 million, it doesn't get a step up in basis. Her basis is still $150,000 in her $1.5 million of stock. Again, because they bought it 25 years ago for $300,000 and it was worth $3 million when Fred died. Wilma's half, they paid $150,000 for Wilma's half, and it's worth $1.5 million when she dies. And so her basis and her stock doesn't get adjusted. So even after Fred dies, there's $1.35 million of capital gain that is still untaxed that will get taxed when she sells that stock. All right, so here's the tax trap. If you do move from a community property state like Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin, to a separate property state where there's no income tax, like Florida or Wyoming, you'll likely lose that full step up in benefit that you would gain if you would have stayed in a community property state. Think about that. You moved to avoid state income taxes, maybe saving a few $1,000s a year, but now your family might owe 6 figures or more in capital gains taxes down the road. All right, so let's put some numbers to it and look at an example. So by moving to Florida, let's say Fred and Wilma avoided $12,000 of state income tax each year. And they avoided that tax each year for 15 years. They moved from a state that had a 4% state income tax. And let's say they had $300,000 annually in income that would have been subject to the state income tax had they stayed in that state that had a state income tax. So they saved $12,000 a year for 15 years. That's $180,000 of state income tax savings. Sounds like a pretty good deal. But by moving from the community property state to Florida and losing the community property step up in basis, then after Fred died, Wilma incurred an extra $270,000 of capital gains tax when she sold that stock after Fred died. Again, she lived in Florida. Fred's one half of the stock got a step up in basis when Fred died, but Wilma's half of the stock did not get a step up in basis. So when she sold that stock, there was $1.35 million of capital gain. And so let's say there was a capital gains tax rate of federal, capital gains tax rate of 20%. So she incurred an extra $270,000 of federal capital gains tax as a result of them moving from a community property state that does allow the full step up in basis on all of the community property to a step up in basis where only the deceased spouse's assets get a step up in basis when the first spouse dies. Only the first spouse's assets get a step up in basis. Okay, so there was a mouthful, but the key here is really to be informed and make an informed decision. I see a lot of talk about hey, we're going to retire, we're going to move to a state where there's no state income tax. It's going to give us lots of savings. Yes, and so in the short run, you may have some significant decrease in state income tax liability. However, at the end of the day, when assets are sold, perhaps after you pass away, family may incur significant capital gains tax because you moved perhaps from a community property state to a separate property state. Okay, so yeah, if you're ready to get your estate plan started, just hit the link in the description below to request a Zoom estate planning design meeting with me. We'll walk you through everything together. We'll see you next time.